companies that are very sustainable, that have taken a view on sustainability and implemented actual policy already years ago, that they're now actually front runners, and they're like the global leaders or examples on how to manage ESG risks, and it translates into value. So I'm Maurits de Haan. I'm a partner in the Corporate M&A department of Houthoff. I've been with Houthoff for over 12 years now. Went to Houthoff straight from the college benches, basically, or university benches. Studied corporate law. I go to work whistling and singing every morning. I told myself, as long as that's the case, I'll stay with Houthoff. Basically, if we're talking about ESG in M&A and the impact of ESG on the M&A process, then if we start at the beginning, there was no impact of ESG on M&A. If you talk about 12, 13 years ago, 20 years ago, the goal was to sell your company at the highest price, and what the company did was not that relevant. Basically, the profits that came out of it were the driver for the value that was paid in the transaction. Okay, so for companies, it's not only important anymore to show financial results, they also need to show that they're actually working on becoming sustainable and conscious of the impact that they have on environment and people. So the drivers for that are, I guess, threefold. First is public pressure, second is regulation, and third is valuation. In terms of public pressure, what you've seen in the past, and this is some years ago, is that the Netherlands was basically one of the starting points for discussion about companies needing to be more sustainable, right? People had already incorporated sustainability to some extent in their life with trying to reduce their own carbon footprint, and people started looking at companies to do the same because companies have a much bigger impact on environment than a typical household or even 10,000 households. So what we saw was, for example, the Urgenda case, which was a landmark decision here in the Netherlands, which forced the Dutch government to actually abide by its intention to reduce carbon dioxide or greenhouse gas emissions by 20% by 2020 compared to 1990. And what the judge said there is, hey, if you say that you're going to do something, basically, then you should stick by it, and there should be actual policy to go there. And there is no actual policy right now, so Dutch government go to work. Now, a good example of a company that was scrutinized by public pressure is Shell, which was faced by litigation by activist shareholders, but also public interest groups, to reduce its carbon dioxide footprint, but I guess by 35% by the year 2030 compared to 1999. And the judge said, hey Shell, you're saying all sorts of things that you're working on this, but I can't see it concrete enough, so you need to do more. So that's two good examples of how public pressure has now factored into corporate life. What you see now is that on the back of that public pressure, there has been an increased regulatory effort by both the Dutch government and in particular the EU. So Dutch government, based on the Urgenda case, they came into action and basically came with an action plan to reduce greenhouse emissions by 20% by 2020. Now we've already surpassed that point. So what we now see is that the Dutch regulation is deemed insufficient. So what we see is that the EU has taken over the role of the Dutch government on the basis of the Urgenda case, and the EU has seen the importance of reducing emissions and has launched a very ambitious pack of legislative initiatives. Most importantly, the EU Green Deal. And the EU Green Deal is a huge package of regulatory initiatives that basically drive towards getting the EU carbon neutral by the year 2050. Now, to get carbon neutral by the year 2050, huge changes are required. And these regulations that they're introducing are therefore very strict regulations that are very difficult to comply with for some companies. They're about reducing the amount of energy that you use as a company, doing that in a much more efficient way, making it more expensive to actually produce greenhouse gases. So the carbon dioxide trading mechanism undergoes a transformation. On the back of this regulation, also the SFDR, which is the Sustainable Finance Disclosure Regulation, which imposes an obligation on financial market parties, but that also includes, for example, private equity, to disclose on whether they are seeking to go for sustainable investments, or whether certain of their products are sustainable, and if those are sustainable, to very specifically say why those products are sustainable. And if you don't want to do that as one of those parties, then you need to say that you're not focusing on sustainability, which from a valuation perspective may not be the most attractive of choices. So in terms of what can we add in this process, well, I guess that's obvious. The breadth of this regulation is so immense that for companies themselves to understand what regulations exactly apply to them, it is almost impossible. So what we regularly do is just sit down with clients and start talking about what we see in the market in terms of regulations, but also what the client actually does. So what types of business do you have? What parts of the ESG regulation package could then apply? So on the basis of a discussion with the client, we'll make an assessment of what parts of the regulation will apply. And on that basis, we'll try to, at least for now, fix what applies. So we have a framework to work off. And that's the regulatory framework that the company basically operates in. And then on the basis of that regulatory framework, we need to do a deep dive into the business of the client. So basically, very openly discuss, so what do you see in this part of your business? What parts of this specific set of regulations do you think we would touch upon? And this is a session that's not done in a couple of hours sitting down with experts. This is a constant session. So companies are actually starting to see that companies who have a focus on ESG consciousness and impact and taking action on those aspects are more attractive from a financial perspective also for investors and acquirers. So basically what you do by being aware of and acting on ESG requirements or ESG attractiveness is creating value. And that's not only value for people, so the social aspect, for example, of ESG, or climate, the environmental aspect of ESG, but also for investors and shareholders. So it actually turns into a financial component. Step by step, we're starting to see that ESG compliance actually has a financial impact as well, which is a new development, I would say. So traditionally, you would have due diligence in financial, tax, legal. Basically, those were the three ones. My expectation is, on the basis of what we see right now, that ESG due diligence will become a critical part of every transaction that will be in the market in 2 or 3 years' time. That's on the basis of the drivers that I just mentioned. So public pressure, regulation, and increased valuation for companies that are conscious of their ESG profile. So on the back of that, we will see that ESG due diligence will become a critical element in any due diligence process for any transaction. Risks are obvious, right? It's the pressure that Shell has faced, for example, in the litigation is huge. It is all of a sudden they were confronted by a ruling that basically said you're doing things wrong. You need to invest much more in becoming sustainable. And that had a huge impact on Shell. Well, they were working on becoming sustainable for quite some time already, but it wasn't deemed enough by basically the public, and with the public, the judges. So risks there are basically reputation, I guess, but also if the judge says that you need to do something and you don't do that, then it becomes enforceable. So you're open to all sorts of suits for damages, for example, which have a potentially huge impact on these companies. So then the other side is opportunities, right? So if you divide the corporate landscape into companies that are very sustainable and companies that are not that sustainable or not sustainable at all, then I guess you could say already that the companies that are very sustainable, that have taken a view on sustainability and implemented actual policy already years ago, that they're now actually front runners, and they're like the global leaders or examples on how to manage ESG risks, and it translates into value. So what developments can we expect? Well, most certainly more legislation. The question is, what will that legislation lead to? So what will society look like? What will companies look like in the future? I think my expectation, and this is an estimated wild guess, I would say, but based on developments right now, I would expect that in 10 to 15 years' time, each company within the European Union will have some form of ESG rating. So that's just a rating based on data from within the company on your score on environment, social, and governance, each of those aspects. And if and when that happens, and each and every company has a scorecard like that, it will be possible to benchmark companies, compare them basically to each other. And if that is indeed what the future beholds, then I guess it's time to get to action already now, to basically be a front runner by the time that this becomes reality. A naive approach would be to wait out the storm, because we're already in the middle of the storm. The storm is there. You cannot wait. The storm is there. The regulations are there. You need to come into action right now. Question is, what can we do for you in terms of getting to ESG compliance and going beyond ESG compliance, getting ready for the future? What we can do for you is allow you to understand the regulatory framework that applies to you. Not only the regulatory framework that applies right now, but also the regulatory framework that is expected to enter into force in the near future, in the not so near future. Basically prepare you for what's coming. That's only one part. So getting the regulatory landscape in order, or in view. Then the second is to basically sit down with you and understand what type of investigation you need to do into your business to understand how you rank against these rules and regulations. Where do you comply? Where don't you comply? Where do you need to take action to actually comply? Where do you need to take action to be able to comply in the future? And I guess that's where we come into play. We would like to sit down with you, talk about this, get to know your business, and help you understand what you need to do from a legal perspective to become ESG compliant and beyond.